Welcome, my name is Vincent Luce with Forex Trading Institute. Please take a couple minutes to read the following risk disclosure. Lesson 2, Trading Japanese Candlesticks. I like to start off with a little saying about the market, and it goes like this: don't tell the market what to do, let the market tell you what it's going to do, and then go with it. In this lesson, we're going to cover Japanese candlesticks. And Japanese candlesticks are candlestick formations, and they are the sign language of the market. They communicate to us and tell us where the market wants to go. And they give us buy and sell signals. Bullish candlestick formations, and bearish candlestick formations. Bullish candlestick formations are composed of three main ones, which are called bullish engulfing candles, morning stars, and tweezer bottoms. Bearish candlestick formations are composed of a bearish engulfing candle, evening stars, and tweezer tops. And we're going to learn how to read these and recognize these in charts. Now, a Japanese candlestick measures a fluctuation of price during a certain period. It could be a daily chart, it could be an hour chart, it could be a 4-hour chart. And depending, if I say a daily chart, I mean that each candle is worth a day. If I say a 60-minute chart, each candle is worth 60 minutes. Now, the candlestick has three main components. It's got a wick, it's got a color, and it's got a body. The body tells us where the candle opened and closed. For example, here it opened and closed here. The body is always where it opens and closes. The color tells us if it opened low and closed high. For example, this white candle signaling that it opened low and closed high, or it opened high and closed low. And the colors could change depending on your charting package. You could program into whatever colors you want to signal a candle that's going up and a candle that's going down. A wick tells us the highest the price got during a certain period and the lowest it got during a certain period. So if we were looking at a daily chart, this would mean this is the highest that it got during the day, and this is the lowest it got during the day. And this would be considered a bullish candle, and this would be considered a bearish candle. The market went up here, closed, opened low, closed high. Here it opened high and closed low. That would be a bearish candle. Then there's decision candles and indecision candles. A decision candle is one where the market has a direction, a clear direction of where it wants to go. For example, here it's clearly going up. It has very little wick. The wicks, the combination of the wicks, it could be the top wick and the bottom wick, has to be smaller than the body. For example, this would be a clear decision. The market would say, I want to go up. Here the market's telling me, I want to go down. It's a bearish candle. This is a bullish candle. An indecision candle is one where the wicks are bigger than the body. The market's undecided what it wants to do. For example, here, look at it, open here, closed here, and it had gone up and then it had gone down, but it opened and closed very close by where the opening and the closing was. Here the opening and closing, very indecision candles, and these have names. This would be a spinning top, a doji, a dragonfly doji, gravestone doji, and a hammer. Now, when there's a combination of these candlestick formations, they give us signals, buy and sell signals. For example, this is a sell signal. This is telling me short the market wants to go down. And the first one we're looking at here, it's called an evening star. And an evening star is a decision candle followed by an indecision, by a decision bearish, a decision bull, indecision, and then a bearish candle going down. And this, obviously, this was telling us it's a U-turning and the market wants to start going down. There's several rules to trade these, and we're going to go over these rules in the following slides. Now, an evening star formation, this would be an ideal, okay, decision, indecision, decision. This would be more realistic. There could be several candles between. You just want to make sure that the decision candle and then the bearish decision covers at least 50% of this body. Okay, if it doesn't cover 50% of this body, that won't be an evening star. For example, if I had another just a bearish, small little bearish candle here, not covering 50% of this body, okay, it wouldn't be a good evening star. Also, you want to see the prior trend. You want to see that the prior trend is in an uptrend, and this is telling us it's U-turning down. If the prior trend is not an uptrend, I wouldn't take it as an evening star formation. Now, the rules to trade the evening star formation. Okay, first of all, we covered this candle must close at least more than 50%, ideally 60% or more on a U-turn. Okay, so I usually like drawing a little line on more than half the body and make sure that this body closes. This has to be a decision, indecision, and this is a decision. Now, we sell at the opening of the next candle. We have to wait for this candle to close. A lot of errors I see on traders is that they don't let this candle close, and you're going to find that the last 10, especially if you're looking at an hourly chart, the last 10 minutes of the hour are usually the most active. And sometimes it looks like this is going to be forming, and then the last 10 minutes it retraces back and it doesn't form as an evening star. That's why we got to be patient and let this candle close and then go at the opening of the following candle. Now, our stop loss is placed 15 pips above the high. Okay, so we measure from the high 15 pips and we put our stop loss. Okay, not 15 pips. Another error that I see is that traders put 15 pips from this candle where they got in 15 pips. We got to let this market fluctuate. Okay, we just can't go in it. A lot of times you sell, this market will start retracing. It'll try the high of this candle and then it'll go down. If we don't give it room to breathe, that's why we put it 15 pips above here in order to trade this in a short position, selling down. You got to let the market fluctuate. So it's 15 pips above. We got to check and the opening of the following candle. Make sure we put it sell. This bearish candle has to be beyond this candle, and we also want to check the prior trend. We want to make sure the prior trend is in an uptrend. This telling us it's doing a U-turn. Now, morning star formation would be the opposite. This is a bullish formation, and this is ideal. We have a bearish down, we got indecision, and then we got decision up. Okay, so we got a bearish candle of decision, an indecision candle. This one doesn't matter if it's a bullish or bearish as long as it's indecision, and then we got a bullish decision. If you're trading the stock market, you would want this to be, first of all, spinning top, and you would also want this to be bullish. But in the Forex, it doesn't matter. Now here, this would be ideal. This is more realistic. There could be several candles in between, and then as long as there's decision, indecision, 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 and then decision. Now we buy, the same rule applies, we buy at the opening of the following candle. We had a decision, indecision, then we had a bullish candle. We buy at the opening of the following candle. This right here, this was bearish, indecision, and then we had a bullish candle. Don't worry about the colors. Obviously the colors could change depending on the charting package. This was a bearish candle going down. This was an indecision, and then this was a bullish candle going up. We buy at the opening of the following candle. And we place our stop loss 10 pips below. Why 10 pips and not 15? In the other one, we were accounting for the spread. When we enter buying, we exit at the sell price. When we enter selling, we enter at the buy price. Here, like we're entering buying, we're going to exit at the sell price, so the spread is already adjusted. We also want to make sure that this is coming on a downtrend. Now, the second formations of bullish or bearish, okay, we went over morning stars and evening stars. Now we're going to go through tweezer tops and tweezer bottoms. First, let's look at the bearish signal, the sell signal here, which is called the tweezer top formation. And the tweezer top, in order for it to be a tweezer top, it has to have very little body, less body than wick. Here we see wick minimum 60%, body maximum 40%, and we have to have the wicks almost at the same level. Okay, it could be within a couple of pips. I would say 8 to 10 pips difference. Basically, don't get too caught up with how many pips difference. Just get caught up that they're at the same level. Because what the market's telling is it tried to rally, it couldn't. It tried to rally, it couldn't. So there's a resistance here in the market. And the same rule applies. This is ideal. This would be more realistic as long as at the wicks are almost at the same level and we have very little body. Doesn't matter how many candles are in between. Okay, rules for trading these tweezer tops. Okay, the tweezer top formation. First of all, we sell at the opening of the next candle. We place our stop 15 pips above. Remember, 15 pips above the high, not 15 pips from when we enter. And we also have to make sure that the trend isn't here. It was going up. It was making a retracement. The prior trend was going up, and this is giving us the U-turn signal. The tweezer bottom formation is the opposite. It's a buy signal. Here the market told us, I want to go down. I can't. I tried to go down. I can't. It's giving me a support in this area. Okay, and this is ideal, and this is more realistic. Okay, this is ideal, and this is realistic. Okay, same rule applies. Very little body, more wick. Okay, very little body, a lot of wick, and the wicks almost at the same level, within a couple of pips. This is ideal. This is realistic. There could be several candles below. Okay, and you see here, very little body, but the wicks are at the same area. That's a tweezer bottom formation. The rules for the tweezer bottom applies. We buy at the opening of the next candle, and we place our stop loss 10 pips below the bottom. Always 10 pips below, 15 pips above. And we got to make sure that the prior candles here were in a downtrend. This is giving us the U-turn signal that the market has hit the bottom and it's going to the top. You're going to see that we look to find in areas, and we're going to learn about ABCDs and trends in future lessons. And these are the formations that you're going to look for in a specific zone. And this is something I want to clear up. We look for these formations in a specific zone. We don't just buy every single morning star or every single evening star. We need confirmation that they occur in a certain zone, and we're going to learn that during the course. Now, the third formation is called an engulfing bullish candle. And the rule here, there was a bearish candle, bearish candle, bearish candle, and then we had a bullish candle. This engulf means it covers the prior candle, the body of the prior candle. This body, this bullish body, this white body covering this body. You see how this body is inside of this body? That's a bullish engulfing candle. This has to be bearish, and this has to be bullish, and the body has to cover the prior candle. If it does not cover the prior candle, then it's not a bullish, and it has to cover it by a nice margin. Don't just see that it's a mere cover. Obviously, by the more candles it covers, the stronger the signal. In this case, it was covering two bodies. It does not have to cover the wick. It just has to cover the body. Now, a bullish here engulfing candle, the rule says we buy at the opening of the next candle. Okay, so here's bearish, bearish, bearish. It gives us a bullish engulfing. We buy at the opening, and we place the stop loss 10 pips below. Okay, very important. 10 pips below, we place the stop. Another thing I like about bullish engulfing, that they become future levels of support and future levels of resistance, which we're going to learn in future lessons. I usually also like drawing a line across the bottom here, because if the market tries, most of the time it comes back, and if I can't buy here because there's too much risk, I always have to measure my risk management to see between where I'm getting in and where my stop loss. If there's too much risk here, I will look to buy near this line, this support, because it usually comes back here, respects this bullish engulfing, and then it goes in the up direction, in the bullish direction. So usually the bullish engulfing, I like them, they usually give you two opportunities to get into the market. A bearish engulfing candle, same thing, just inverse. The market was rallying up. It was a bullish candle, and then we have a bearish candle which is covering the prior body. Okay, it only has to cover the prior body. If it covers more than one body, obviously it's a stronger signal. You just want to make sure that this is U-turning, and this would be a sell signal. The same rule applies. We sell at the opening of the next candle. We place our stop 15 pips above. Okay, we place our stop 15 pips above, and we sell at the opening of the next candle. And here we could see it in a chart. Okay, the market's going down, and we have a bullish candlestick formation. Look here, we have a white candle covering a black candle. The market started rallying, and then here it gave us an evening star. Look how we had decision, indecision, decision. The market started going down, and then we had another bullish engulfing. This white candle covering this black candle. It started telling us that the market was going up. And then look at here, we had a tweezer top. We had two wicks almost at the same level. Okay, the same level, very little body, and the prior market was in an uptrend. You know, always remember, you want to make sure it's giving us a reverse signal. Here it's giving us a reverse signal down. This is giving us a reverse signal up. Just like here, the market was going down, and then we had a bullish candle, a white candle covering a black candle, giving us that the market wanted to go up. Now here's a good example of an evening star I would consider. Put it up here. It is for example, a bullish candle, and it's also a morning star, and then we had an evening star following it. But look at here, it was a bullish candle, but the prior trend was up. Okay, you want to make sure that the prior trend's down. Now this would be a good evening star because the prior trend was up, and we had a decision, indecision, and then bearish decision. Just like here, look at it, was rattling up. It was making a little retracement up, and then we had two candles at the same level. We placed our stop loss above that level. Okay, and these formations are found in all time frame: 15-minute charts, 30-minute charts, 1-hour charts, 2-hour charts, 4-hour charts, daily, monthly, even yearly time frame. The larger the time frame, usually the stronger the signal. The smaller the time frame, usually it's going to give us a smaller risk, but it's not as strong as a larger time frame. Now I want you to go over these rules. Japanese formations offer the best reward opportunities. Japanese candlestick formations are potential turning points when traded in the direction of the trend, and they have a higher percentage of a chance of paying off. They lend themselves to what is called great equity management. You can execute a trade with a tight stop. If the trade doesn't work out, your loss is small. And it says the key rule is keep your losses small and let your profits run. Now, over 50% of the time, you got to make sure that the market's going to test the candlestick formation. What does it mean to test? It means it's going to try to go to the high or the low. It's going to do the formation. You're going to get in, and then it starts going against you, but it only goes to the high or the low. Remember, the bulls and bears are fighting for control. If it is a bullish formation, the bulls will test the low. If it's a bearish formation, the bulls will test the high to see any buying interest. That's why we place our stop loss above. So this is something, and you're going to get this with practice. Well, I want to see you demo trade these formations so you understand how they test the highs and the lows of the market. These are some tips. Always trade in the direction of the trend. Obviously, just waiting for a retracement. You're going to trade. You're going to look at the trend on a daily time frame, on a 240 time frame, on a 60-minute time frame, and you're going to wait for just a small retracement, and then get in the direction of the trend. Always, check your trend lines in different time frames. Okay, that they usually appear in various time frame. All these formations. The larger the time frame, obviously, the stronger the signal. Do not trade candlestick formations when the market's in consolidation. And all protected start loaders must be 15 pips above when selling and 10 pips below when buying. If your stop loss is too far from the entry point and it does not meet your equity management, a maximum of 50 pips or pass on the trade. Obviously, if it's a little more than 50 pips, you can take it as long as you're under that 5% rule, and go and find other trades that will meet your equity management. For example, here we're seeing, look at the market going up, okay, and then it did a small retracement back, and then it gave us a bearish candlestick formation. We place our stop loss 15 pips above the high, and we enter selling at the opening of the following candle. And look at how the market went straight down from that position. Sometimes it'll test it. What do we mean by test? Remember we said 50% of the time? Okay, it will test it and go back up. In this example, there was a lot of pips here. There's over 150 pips. It might be too risky to get in the trade. You might be breaking your 5% rule. It means you're risking more than 5% of your capital in one trade. Okay, so we place our stop loss 15 pips above, and we enter selling, okay, at the opening of the other candle. Sometimes when it doesn't give, we might want to wait for a retracement. Same thing I do with a bearish, bullish engulfing. You might want to draw a line here, because this will become a level of resistance, these bearish engulfing, and the market will rally back and try to sell as close as to that line. Then you get a much better, if I sell close to this line that I would draw on the top of the body, I would get a very good equity management. Put your machine on pause and read over these rules. It's better that you read over them than I read them to you. A lot of these guidelines that you're going to see here, we're going to look at it in future lessons, like how to draw trend lines and support and resistance and Fibonacci. Okay, put your machine on pause and read over these following rules to trade candlestick formations. Okay, read over these rules on stop reverses on candlestick formation. Put your machine on pause and make sure you understand this and read through this. Okay, only trade candlestick formations at the end of a price move, and you're going to find out about Fibonacci levels that help us use, and you're going to see that we're going to use find these levels at convergences when they're near a C, and we have, for example, a Fibonacci level, we got a trend line, we got a support, a resistance. There's where we look. There's certain zones I'm going to teach you where to look for these formations. But first of all, we got to learn these formations, and this lesson was to go over these formation. And obviously, don't trade these candlestick formations when the market's in consolidation or in the middle of a price move. You want it to become after retracement near C levels. We're going to learn how to find C's. Okay, my name is Vincent Luz, and I'll see you on the next lesson. Thank you for taking your time to invest in your education, and I'll see you in the next lesson.